Greetings, welcome to another CrashWatch video in our CrashWatch series of videos. And this is a rather unusual time in the market because the market is declining in an orderly and gradual way, but is still declining very quickly, and many people don't realize how far down it could go because they're not looking at what the level was just 2 or 3 years prior, in which case even the bottom that I'm predicting is not very low at all. So we first look at the S&P 500, so I'm going to hide my face. This is the S&P 500 5-year chart, and the last time I did a CrashWatch video was June 20, which you can see in the description box below. Since that time, there's been a small rally, and it seems the same pattern is going to manifest. A small rally, and then a new low, a small rally and a new low, and I still say the ultimate bottom is in the low 3000s for the S&P 500, because that is not low relative to 2017, 18, 19. Yes, there is a trajectory trend line of growth for the S&P 500. Sometimes it's well above the trend line, such as we saw over here at the ultimate peak of the market, and sometimes it goes pretty far below the trend line like we saw in late 2008. But just trend line alone would be low 3000s, and then it could very well go somewhat below that. But low 3000s is the call that I've continued to make. I started doing the CrashWatch videos right around here at the top in February. Now what is unusual is that the head and shoulders pattern that I had described in earlier CrashWatch videos actually did manifest, and that is usually a sign of a major market crash. But since that time, rather than going straight down, things have gone down in a managed way. And this lends evidence to the idea that the stock market is being manipulated by the Federal Reserve and other government entities. Now, to the extent that they're manipulating it, they're doing a good job because this is kind of a gradual sort of thing rather than a very steep decline that causes a disproportionate amount of panic, even if it arrives at just the same destination. However, they have been dealt one curveball, one black swan event already, which is the oil price spike, because one hand of the government, the Biden administration, obstructed U.S. domestic oil and natural gas production, which caused the price to rise, and that hand is not speaking with the other hand of the government, the Federal Reserve, which is supposedly independent, but they don't coordinate with the rest of the government when they're supposed to, and they do coordinate when there is less value to coordination. And since oil rose from $50 to $80, the Biden administration thought that they could keep it at $80, which is a decent price for gradual technological disruption of oil. That emboldened Mr. Putin, which shot oil up to $120 a barrel, because other aspects of the U.S. government actually want a war between Russia and Ukraine, because the U.S. military-industrial complex needs endless wars in multiple parts of the world. Separate topic. But the Federal Reserve, to the extent they're manipulating the stock market, has managed an orderly decline. Now the problem is, by overdoing the tightening on other sides, such as raising the Fed funds rate at bigger and bigger increments when, of course, the long-term Fed funds rate should be zero, that could really make things fall apart and fall a lot faster. The tightening that the Federal Reserve is doing of its balance sheet is being done in a very, very gradual, managed way. They've only tightened about $45 billion so far. In June, that was the first month of actual tightening. July is meant to be $60 billion. August, $75 billion, and September, $90 billion. And that's why I think the ultimate stock market bottom is around the October timeframe, low 3000s. That is my general estimate. Now, of course, this is just my opinion, and for educational purposes, don't make any trades or not make any trades because of anything I say in this video. This is for only educational purposes. So this is the S&P 500 and the gradual downshifting trajectory that it's on. Now, if they can manage it this well, why did they let it get this high in the first place? I don't know. Now we go to the next item that is a factor in stock market and economic performance, which is oil prices. This is USO, United States West Texas Intermediate Oil Prices futures, and an ETF that encompasses those futures. The aforementioned obstruction of U.S. domestic oil and natural gas production caused this oil price spike that we see here, and then the invasion of Ukraine by Russia caused more rise in oil price, but it is still hovering around over here, which is much higher than what it was just a year ago. This is a one-year chart, and this is adversely affecting everything from United States trade deficit to corporate earnings to CPI inflation. And the problem with the effect on CPI inflation is that it's only a temporary spike in CPI inflation, but the Federal Reserve is taking very drastic, very excessive, and hard to reverse measures to fight inflation that has already been in the past, and thereby raising the Fed funds rate to an unusually high level. This is going to be a problem because they're going to be forced to reverse the Fed funds rate again. but high oil prices are a drag on the stock market and the economy and everything else that feeds into each other. So this can cause a negative vicious cycle in terms of downward pressure on the market and the economy. So oil prices are still high. In looking at the Fed funds rate over here, notice how they were increasing it gradually in 2016 or 17, which is what they should not have been doing. That caused a major stock market correction and a predictable weakening of internals. But remember, these are hyper-theoretical PhD economists. And for all the 600 PhDs of the Federal Reserve, they only look at two metrics, which are the CPI inflation rate and the unemployment rate. Nothing else about Federal Reserve decisions is governed by anything beyond just those two things. You don't need 600 PhDs to look at two things. And yet they come to the wrong conclusion because they were already lowering rates long before COVID. This emergency lowering because of COVID, in fact, brought the Fed funds rate to the correct level, 0, because we are in a technological deflationary age. In other videos, I talk about the Wuxia shadow rate. That's why there has to be a 0% Fed funds rate and permanent quantitative easing, and that to a more diffuse type of quantitative easing than exists now. But this rapid drop is something that would have happened anyway without COVID. They would have lowered it by late 2020 anyway. But now, because they overshot and because the oil price spike is making the CPI high and the Federal Reserve is not saying, hey, it's not because of our quantitative easing, it's because of the Biden administration stopping domestic oil and natural gas production, they're shooting up rates really high, and now they're talking about a 1 point increase at the next meeting. That will take it from 1.75 to 2.75. But even if they do just 3/4 of a point, that's 2.5%. That is way, way, way too high and presages a major stock market crash and a very embarrassing lowering of rates again. At what point are they going to realize that all market forces are forcing rates to be about 0 now? Because we're in a high-tech age. This is a 25-year chart. This is the atom age over here. Their misguided attempt to raise rates, which was reversed again, and it'll be 0 again. I've been predicting this for a long time. My atom publication was out in early 2016, and on my blog, The Futurist, I spoke about this for many years before that point as well. So now this brings us to the final thing we should look at in terms of collective cumulative items pressuring the stock market, which is mortgage rates. This is the Federal Reserve 30-year mortgage rate, 5.51. But notice how it was going lower and lower and lower because of the Federal Reserve's easing, but it was naturally low for most of the 10 years before that point as well, 3.5 to 4.5%. Things were good in 2015, 16, 17, 18, right? Now, because of the speed of their tightening, they have created the steepest rise you could possibly imagine. From something that was super low at the end of 2021 to now 6 months later, almost twice the interest rate. And this is extremely bearish for housing. This is a steeper rise than had occurred even before the 2008 housing bust. And a lot of people don't realize that when interest rates are low, that is not the time to buy a house. You want to buy when interest rates are high and then wait for interest rates to be low later on. A 3% interest rate on a $1 million mortgage versus a 5% interest rate on a $600,000 mortgage may seem like the same thing because the payment is the same, but in terms of future home equity upside, the two are very, very different. The latter is what you want because you're getting locked into a $600,000 mortgage and a house price proportionate to that. And when rates get lower, you get all of that equity. Buying a home on mortgage is really just a very leveraged bet on interest rates of mortgages. That's why it's a two variable equation. A lot of people don't understand that. So many people were lured into buying houses because rates were low, and now they're going to be in negative equity because they cannot survive home prices going back to even the 2019 price, which in many cases would be 30 or 40% lower. If they made a 20% down payment on their home and the home price goes 30% lower than at the time that they bought it, they are going to be in negative equity. And what will the Federal Reserve do? They will do more QE. That involves buying mortgage-backed securities, but they are putting water in a sieve because this stimulates more construction of homes and more supply. I've done other videos about this across this channel about how the Federal Reserve's super narrow type of QE has created a situation that they just cannot back out of. They're filling water into a sieve, and all market forces are going towards the obvious conclusion of giving cash directly to people, but that is also a topic for other videos I already have up on this channel. But when mortgage rates rise this much, this is going to cause a housing crash and a tremendous contraction in GDP because all housing construction will stop as well, which causes further reduction in demand of housing. So the Federal Reserve has cornered itself, but only for ideological reasons. The stock market crash also is something that causes a broader recession because it lowers employment. Corporations lay people off and at a minimum cancel all open positions. That is also what they don't understand. The Federal Reserve, once again, is manned by very theoretical people, and they are causing a recession that didn't need to be caused because they are reactive and they overshoot in both directions and both extremes each time. So that is the CrashWatch update, and things are proceeding as has been predicted. You can refer to all the prior CrashWatch videos that are in the description box below to see that. Unfortunately, this is going to be a lot of unnecessary hardship for people because the Federal Reserve tends to overshoot on both sides, and the less sophisticated people who buy houses at the top or get into high beta stocks at the top are the ones that are going to suffer the most. And the most cynical people say that this is deliberate. I don't think that's true. I just think that the people running the government are very theoretical and are too shielded from the consequences of their own decisions, so they don't really care how these very outdated policy ideas affect average people. But there we are, S&P 500 continuing to decline as predicted. If you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.